For years, SCHD has been the undisputed king of dividend ETFs. This fund has dominated every dividend investing conversation, every portfolio recommendation, every YouTube video about passive income. With $71 billion in assets under management and a track record that made grown investors weep tears of joy, SCHD was untouchable. But something absolutely shocking happened in 2025 that no one saw coming, and it's going to change everything you think you know about dividend investing. VYM, the Vanguard High Dividend Yield ETF that most people overlooked as just another boring index fund, just delivered a 7.66 percentage point knockout punch that has the entire dividend investing world questioning everything. We're talking about VYM posting a positive 6.5% return year-to-date, while SCHD is sitting at negative 1.16%. That's not a small difference, folks. That's a complete and total reversal of fortune that's rewriting the dividend ETF playbook as we speak. Let me tell you the story of how we got here, because understanding this shift could literally save or make you thousands of dollars in your dividend portfolio. I'm going to break down exactly what happened, why it happened, and most importantly, what you need to do about it right now. SCHD didn't become the reigning champion by accident. This ETF built its empire on a simple but powerful philosophy: quality over quantity. While other funds were stuffing their portfolios with hundreds of mediocre dividend stocks, SCHD took a different approach. They handpicked just 103 companies using the Dow Jones U.S. Dividend 100 Index, which employs some of the most stringent quality screens in the ETF universe. We're talking about fundamental strength analysis, consistent dividend payment history, financial stability metrics, and sustainable payout ratios. It was like having a team of expert analysts personally vetting every single stock for your portfolio. And the results spoke for themselves. Since inception in 2011, SCHD delivered a staggering 12.25% annualized return. That's the kind of performance that turns regular investors into dividend evangelists. The fund became the gold standard, the benchmark, the ETF that every dividend strategy was measured against. With its rock-solid 3.79% current yield and consistent dividend growth, SCHD seemed invincible. It was printing money for investors while they slept. But here's where the story gets interesting, and frankly, where most dividend investors got caught completely off guard. 2025 was supposed to be another victory lap for SCHD. The fund had weathered market storms before. Its quality screening methodology had proven its worth through multiple market cycles, and dividend investors were sleeping peacefully knowing their income was secure. Then the unthinkable happened. While SCHD stumbled into negative territory at minus 1.16% year-to-date, VYM exploded upward with a positive 6.5% return. That's not just outperformance, that's a complete demolition of everything we thought we knew about these two funds. The psychology of this reversal is fascinating and terrifying at the same time. Dividend investors, myself included, had become so comfortable with SCHD's dominance that we stopped questioning whether it could continue forever. We assumed that quality screening would always win, that concentrated portfolios would always outperform diversified ones, and that energy and consumer staples would always be reliable dividend sectors. We were wrong. Dead wrong. I've been tracking these ETFs for years, analyzing their performance, studying their holdings, and I can honestly say I have never seen a reversal this dramatic and this sudden. It's like watching a heavyweight boxing champion get knocked out by an opponent nobody saw coming. The question everyone's asking now is simple. What the hell happened? The answer lies in one company that changed everything: Broadcom. Yes, that's right. A single semiconductor company became the catalyst that flipped the entire dividend ETF landscape upside down. Broadcom now represents 6.84% of VYM's portfolio, making it the fund's largest holding by a significant margin. While SCHD was playing defense with its traditional dividend sectors, VYM was unknowingly playing chess, positioning itself perfectly for the artificial intelligence and semiconductor boom that dominated 2025. But the Broadcom story is just the tip of the iceberg. The real battle here is a clash of investment philosophies that's been brewing for years: energy versus technology, concentration versus diversification, traditional dividend strategies versus evolved market realities. SCHD went all in on energy with a massive 19.23% allocation to the sector. Companies like Chevron and ConocoPhillips became anchor holdings, representing the fund's commitment to traditional dividend-paying industries. Meanwhile, VYM allocated 14.7% to technology, nearly double SCHD's 9% tech exposure. It turns out that in 2025, technology dividends became rocket fuel, while energy dividends became anchors dragging portfolios down. The irony is delicious and painful at the same time. The very sectors that made SCHD a champion became the sectors that led to its 2025 struggles. It's like watching a master chess player lose because they refuse to adapt to new strategies. The diversification story is equally compelling. SCHD's concentrated approach of 103 carefully selected holdings seemed brilliant until it wasn't. When your top 10 holdings represent over 41% of your fund and those sectors underperform, there's nowhere to hide. VYM's 583 holdings meant that no single sector or stock could sink the entire fund. Sometimes having all your eggs in fewer baskets backfires spectacularly, and 2025 was one of those times. Now, before you rush to sell all your SCHD and buy VYM, let me give you the complete picture, because this story has more layers than you might think. VYM might be winning the performance race, but SCHD is still the undisputed income king, and that matters more than you might realize. Let's talk real numbers that hit your bank account. SCHD's current SEC yield of 3.79% absolutely crushes VYM's 2.57% yield. If you invested $10,000 in each fund today, SCHD would generate approximately $379 annually, while VYM would only produce $257. That's a difference of $122 every single year, or about 47% more income. For retirees or anyone depending on dividend income to pay bills, that difference isn't just a number on a screen, it's grocery money, it's utility bills, it's real cash flow that matters. Even more impressive is SCHD's dividend growth momentum. While VYM's dividends actually declined by 1.02% over the past year, SCHD increased its dividend by 8.58%. Think about that for a moment. In a year where SCHD underperformed in price appreciation, it still managed to grow its income distribution by nearly 9%. That's the power of quality dividend screening at work. The holdings breakdown reveals why these differences exist and why this battle is far from over. SCHD's top holdings read like a who's who of dividend aristocracy: Chevron, PepsiCo, ConocoPhillips, Altria, AbbVie. These are companies with decades of dividend payment history, strong balance sheets, and proven ability to maintain payments through economic cycles. VYM's top holdings, led by Broadcom, include JP Morgan Chase, ExxonMobil, and Walmart. It's a more diversified mix that reflects the broader market rather than concentrated dividend quality. Here's what smart investors are actually doing right now, and it's not what you might expect. Instead of choosing sides in this SCHD versus VYM battle, they're embracing a hybrid approach that captures the benefits of both strategies. Some are going 70% SCHD and 30% VYM to prioritize income while adding diversification benefits. Others prefer a 50-50 split to balance income and growth potential. The most aggressive are flipping to 30% SCHD and 70% VYM, betting that diversification and tech exposure will continue to outweigh pure dividend yield. The market environment we're in right now makes this decision even more critical. Federal Reserve policy expectations suggest that rate cuts could favor VYM's growth-oriented dividend strategy over SCHD's high-yield approach. When interest rates fall, investors typically move away from high-yield securities and toward growth potential, which could continue VYM's outperformance streak. On the flip side, if inflation rears its head again and rates stay elevated, SCHD's higher yield becomes more attractive as a bond alternative. But here's the million-dollar question that's keeping dividend investors awake at night. Is this 2025 reversal a temporary blip or a permanent changing of the guard? The data suggests we might be witnessing something more significant than a single-year anomaly. VYM's 5-year annualized return of 14% now exceeds SCHD's 11.73%. The one-year performance gap is even more dramatic, with VYM posting positive 10.9%, while SCHD sits at negative 0.09%. The sector rotation we're seeing isn't just a 2025 phenomenon. It's part of a broader evolution in how dividends work in modern markets. Technology companies that once reinvested every penny into growth are now mature enough to return cash to shareholders while still maintaining innovation leadership. Meanwhile, traditional dividend sectors like energy face long-term headwinds from the transition to renewable energy and commodity price volatility. So what's your action plan for the rest of 2025 and beyond? If you're primarily focused on current income and need that cash flow to pay expenses, SCHD remains your best friend. The 3.79% yield and positive dividend growth momentum provide a solid foundation for income-focused strategies. But if you're thinking long-term and can reinvest your dividends for compound growth, VYM's superior diversification and technology exposure might be the smarter play. For most investors, the answer isn't choosing one or the other. It's determining the right allocation between both. Your age, income needs, risk tolerance, and investment timeline should drive this decision. Younger investors might favor VYM for its growth potential and diversification benefits. Retirees might stick with SCHD for its superior income generation. Everyone else might benefit from a blended approach that evolves over time. The reality is that 2025 might be the year that changed dividend investing forever. The traditional playbook of buying high-yield, concentrated dividend funds and holding forever is being challenged by a more nuanced approach that balances yield, growth, and diversification. The crown that SCHD has worn so confidently is definitely wobbling, but whether it's actually fallen is still up for debate. What I know for certain is that ignoring this data and these trends could cost you thousands of dollars in missed opportunities or unnecessary losses. The dividend ETF landscape is evolving rapidly, and investors who adapt to these changes will be the ones who build lasting wealth through dividend investing. Those who stick rigidly to old strategies might find themselves holding yesterday's winners while tomorrow's champions pass them by. The battle between SCHD and VYM is really a battle between two investment philosophies: concentrated quality versus diversified exposure. Traditional sectors versus evolving markets, current income versus total return potential. There's no universally right answer, but there is a right answer for your specific situation and goals. The key is understanding these differences and making an informed decision rather than blindly following what worked in the past. This dividend war is just getting started, and the next few months will be critical in determining whether VYM's 2025 dominance continues or if SCHD mounts a comeback. Either way, dividend investors who understand these dynamics and position themselves accordingly will be the real winners in this evolving landscape. If this SCHD versus VYM battle just completely changed how you view dividend investing, smash that like button and let me know in the comments whether you're Team SCHD, Team VYM, or going hybrid with your allocation. Subscribe and hit the notification bell because we're tracking this dividend ETF revolution in real time, and missing the next shift could cost you thousands. Don't let this be just another video you watched. Let it be the catalyst that transforms your dividend strategy and accelerates your wealth building. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.